You reckon we start there?
Go for it, Brad.
Cool. All right. Well, kia ora everyone, and thanks for coming along. I think this is week 4 of our webinar series that we certainly didn't plan an entire month ago, but I guess just speaks to how quickly the COVID-19 pandemic has enveloped the world. My name is Brad Olsen. I'm a senior economist here at Infometrics, and I'm joined by Rob Hayes, one of our other senior economists here. Morning, Rob.
Morning, everyone. Thanks for tuning in.
We've had a fantastic response to our webinar so far, and we're excited by that, of course, able to provide some really useful insights, we hope, to clients. And we've also started to provide a little bit of this information to some other key decision makers across the country, just to make sure that there's that really good regional and local coordination. Look, what we're going to do today, Rob and I, is have a little bit of a discussion again around how we see regional economies developing, and also a discussion as we turn our minds to the recovery and thinking about the week that we're going to have this weekend and where we sort of go to in the future. So I'll sort of, Rob and I will talk for about 20 minutes, half an hour. I'll talk for about sort of 10 or so to start with. I'll hand over to Rob in the middle to give you some sort of deeper insights into how we see the economy evolving for regional areas. That'll be a bit of a preliminary insight into some of our work, and then I'll take off at the end and go through some of the elements of the recovery we see as being critical, and some fish hooks we think need to be worked through. And then, of course, we'll spend the last half an hour going through all of your questions. So if you look at the bottom of your screen, you'll see a lovely little question and answer button. Click on that and feel free to chuck your questions in, and we'll try to answer them towards the end there. If you can, don't chuck them in the chat, just because we don't check the chat as much as we do the Q&A. So feel free to put them in there. But look, just to start with, again, we're nearing 2 million cases of COVID-19 across the globe. Again, some considerable concerns for just how far-reaching the spread of this virus is. And we know that, and probably the most, I guess, risky element we're now turning our minds to is that we've had COVID-19 spread out of China as the first epicenter and into Europe. Europe being the second epicenter, and then going through into North America, into the US. The real risk, though, I'm seeing in terms of where the future pandemic goes, is we're seeing an increasing number of cases coming through in China. And there is a rising fear, I guess, that there may be a second wave of the pandemic coming through. And we know this has happened with previous pandemics like the 1918 Spanish flu. It's not just a one-hit wonder, there is continual action. So concern there, I guess, and just one to keep an eye on is how we continue to keep the number of COVID-19 cases locked down. One thing I did want to share, though, and look, just I guess isolating one of the trends that I have seen emerging and anticipate at the start, is that we're seeing, particularly in New Zealand is a good example of this. We've seen the number of cases that have come through in recent days and weeks soften quite considerably, a very low number of additional daily cases, but we have seen the number of deaths increase, and that's a global phenomenon. Now, I just wanted to show you this chart here. This is the crude death rate. So the number of COVID-19 deaths divided by the number of COVID-19 cases. And you can see over time in this grey line for COVID, that the death rate has started to tick up. And in fact, it ticked up with SARS as well back in 2003. So this is not an unusual one. And I guess just worth noting that we may well see many more deaths coming through yet with COVID-19. Turning as well and having a little bit of a think about some of the new numbers we've got recently, and I do have a large number of new figures to sort of show you this week, but I did want to start on some of the spending figures that we've got from Market View, and if I make sure that I share my screen there. We'll get to that. So we're very, very grateful for the Market View team to provide us some of the figures. And they do make for some really interesting reading at the moment. We still know, of course, that for a lot of people, there's no spending going on. Again, no surprise there. If we look, and we've already canvassed in some of our previous webinars, the progression of spending, of course, leading up to lockdown and then in the first week. If we look at how the second week developed, some interesting trends coming through. Total spending is nearly half its normal level. So again, we know that spending is in a very, very soft place. What is fascinating, though, for me is this rise in food, liquor, and pharmacy spending, and most of that is going to be on food. So I went back to Market View and just asked a few questions to make sure I was getting it right. What we are seeing, and these numbers are only through terminals, so we don't see any online spend here, but it is interesting to see that in the last week, Kiwis have spent nearly 25% more on groceries effectively than they did at the same point last year, even though they're in lockdown. Now, I think what that demonstrates to me is, particularly as a millennial, is sometimes it's very hard while working at home to know if I'm bored or if I'm hungry, and so trying to get that mix right is often quite difficult. And I think that is something that probably a lot of Kiwis are grappling with. Some numbers just out in the last sort of hour or less than from Stats NZ indicates that food prices haven't actually moved materially in the last wee while. Food prices only up 0.2% over the last month. So it doesn't actually seem like we are having to face materially higher prices. There might be a few things here and there. Cauliflower might be one of them. But generally speaking, the spending changes we're seeing at the moment aren't being driven by necessarily higher prices. What it in fact looks like is we're just buying more. We're stocking up a little bit. We're not going to the supermarket every day to buy bits and bobs. We're doing big shops. And that's probably a change for many of us. Like myself, I'd normally go to the supermarket, pick up a few things for dinner on the walk home from work. I'm now going every Saturday to get a bulk set. So some changes there, but again, you can see that outside of our sort of food retailing, spending numbers remain incredibly flat. And what I guess these numbers will become even more in focus once we get to level 3. We start to understand more how the economy is progressing, how quickly or not we may be returning to some sort of normal or new normal spending levels.
Brad, I've got
Yeah.
an interesting point from Paul. Isn't the food spend up also because hospitality spending is down? So people are buying things in the supermarket when they might have otherwise gone to a restaurant.
Yep, no, that's absolutely true, and that's another good point. And in fact, one of the reasons we're all bulk buying as well, because we don't have anything anywhere else to go and get food. I can't go to the local cafe for eggs Benedict, so I've been butchering all of my food at home, trying to make something slightly gourmet. I have done some bread baking, but that's probably the only successful cooking I've done so far. But yeah, it's absolutely right, and this is going to be a big shift for a lot of Kiwis. We're having to suddenly learn how to cook, particularly some of us younger ones who delivery was always the food of choice. But on that, and before I hand over to you, Rob, to go into some of the regional stuff, what I do think is interesting with how we are going to see spending develop is during a lockdown, sure, there is more of a focus on cooking locally or at home. But I think actually once we get into level 3 and even into level 2, there's going to be an explosion in delivery. And I think a lot of firms that have been on the fence around whether or not they look at a delivery service or not, whether they consider Uber Eats or not, they're quite quickly going to find they sort of have to. And I think it's worthwhile, some of those businesses, considering how they prepare and understanding what those changes will mean. But look, I want to hand over to you now, Rob, to take us through. We've been doing some work recently to understand a little bit better how our regional economies are going to perform, and Rob's got some of our latest and greatest numbers on those. So Rob, do you want to share some of those now?
Yeah, thanks, Brad. So we've had a first crack at how we think employment levels are going to be affected by COVID-19. So what we sat down a week or two ago and we thought about how are we going to model this? And so we've made a number of assumptions about how things are going to play out over the next 12 months. And then we've compared average employment levels in the past 12 months with average employment levels in the next 12 months. And I'm going to put up a chart just to show you the beginnings of what we're trying to produce. And I'm going to just talk through what some of those assumptions are. There's the chart. So this is showing the change in employment levels from last year to the coming year across the regions. And so for example, we've assumed that there's going to be, over the next 12 months, there's going to be a decline in foreign tourism of about 90%, a decline in international education of 70%. We've assumed, made assumptions about the money that the government is injecting into the economy. So for example, we've assumed a 9.3 billion injection through the wage subsidy. We've made assumptions about construction. We think construction is going to drop away, partly because of the lockdown and partly because of there's going to be fewer migrants coming into the country. So we're expecting a 20% fall in new dwelling construction. And I think, and then taking all that into account, you've also got to consider that I think of COVID-19 as like throwing a pebble into a pond, and there are ripple effects through the whole economy. So yeah, the tourism sector is going to be impacted first of all. The international education sector is going to be impacted first of all. A range of businesses are going to be impacted by this lockdown. But that reduction in money that's kind of going into the economy then feeds through into other businesses. As people and businesses have less money in their pockets, they spend less money on other businesses. So everyone's going to be impacted eventually. Okay, so look, you'll see that I've deliberately removed the axis from this chart because the numbers are provisional. We're going to be tweaking them a little bit. And so I don't want you to kind of get bogged down too much in the numbers. But what we're expecting is a reduction in employment of about 10% across New Zealand as a whole. And then if you look at the regions that are going to fare worse than others, you've got regions like West Coast, Nelson, Auckland, Otago and Canterbury. So you can look at regions like West Coast and Otago that have a large proportion of their employment in the tourism sector, something like 20% or more in both those regions. So they're going to take a really big hit. In regions such as Nelson, Auckland, and Canterbury, it's a mixture. It's partly the tourism sector and it's partly the international education sector, and that are combining to create that downturn in employment. But as you can see, across most regions, we're expecting to see a pretty dramatic fall in employment. Even Gisborne, which is going to fare better than most regions because it doesn't have that exposure to tourism and international education, we're still expecting to see a drop in employment of something approaching 10%. Now, as I said, we'll be refining these numbers over the next week or two. We've not quite got the tourism impact the way we want it to, and we'll be creating a lot more detail around these numbers. These are the numbers that are going to be going into the regional reports that we've been contacting many of you about in the past week or two. These reports are a direct response to the kinds of questions that our clients have been asking us about COVID-19. One of the challenges of trying to analyze the effect of COVID-19 is that it's happening on a weekly basis, when, as I'm sure many of you understand, that economic data tends to come out on a quarterly basis or even on an annual basis. So what we've managed to do is pin down some data on spending and on traffic flows that changes on a week to week, on a month to month basis, so we can get a real kind of up to the minute sense of what's happening in regions now in terms of economic activity and spending. And then we'll be throwing in these forecasts, these 12-month forecasts, into these regional reports with a lot more detail than I'm showing you here today. We'll be digging into how industries within regions are going to be impacted, for example. It's all going to go into these regional reports to give you a real sense of how things are going to pan out over the next 12 months. I think that's enough from me. I'm going to hand you back to Brad now.
Fantastic, thanks, Rob. And yeah, really important, I guess, that one of the reasons that we're doing this and very much in keeping with some of our other work is obviously local decision makers. They need some numbers to start drawing in on to understand how the economy is going to develop, but also to start thinking about what some of those response plans are. And one of the things, I guess, one of the areas we're focused on and over the next few days is getting our normal forecasts out. Funnily enough, we already had them scheduled to come out this Friday. So our clients will already get some of our forecasts. We'll get those. And because of that process, we've started to do some of this work, like Rob says, to model how we see regional economies performing. And with that in mind, I just want to share something, obviously, and actually to preface this conversation, look, in my mind, this this week is the most decisive week for the government in terms of its economic response and its economic recovery package for New Zealand. We've obviously yesterday had Treasury coming out with some scenarios over how they see the economy could develop, and I'll go through those in a second. You had the Finance Minister today providing a $3 billion package to provide support for businesses to pay their bills, particularly around commercial rents and similar. And tomorrow, and probably the most important announcement of all, Prime Minister outlining how we are going to operate under COVID alert levels 3 and 2. That really, in my mind, is a make or break position for how the business community, how the economy responds. For some businesses, it will give them the confidence to go, yes, I can tough it out. I know I can return to some sort of operation sometime soon. For others, if there's not enough detail or it's not useful, that may be the point where they say, look, it's not worth continuing. I need to reconsider my options quite seriously. So some massive changes coming through this week. But I did just want to step you through some of the Treasury numbers and again, just providing a bit more of that background advice as to how we see the economy going. So a little bit of a preview here of our forecast that we're formally bringing out on Friday, but I don't think the chief forecaster will mind. But essentially, in our minds, Treasury has come up with a range of scenarios, and they have a bunch of assumptions. And I'll leave them on the screen briefly while I talk about them. And you know, some of the worst case scenarios I'd very much hope are sort of unrealistic or off the table for the minute. And that includes scenario 3, which is half a year of level 4 lockdown and half a year of level 3. You know, quite considerable levels of lockdown for the period. But I think what I do want to touch on is that in my mind, the government and Treasury's estimates are being overly optimistic about the recovery phase. I see this as being a much larger hit to the economy, a much more structural shift. Once you have a huge amount of Kiwis, and we're thinking of something around 250,000 Kiwis out of work, when you have a whole lot of businesses that close, there is sort of this threshold of self-replicating downward spiral that businesses can't survive to the same degree. They have to pivot, they have to change, and that's going to take a long time to try and redeploy people. So onto the graphs for a second. What I'm sharing with you here is some of the Treasury scenarios and Infometrics' sort of central scenario for the unemployment rate. And you can see that, and if we look at these two lines here from Treasury, these are their two, this is scenario 1 and 2, but it's adjusted for some fiscal stimulus. And we know the government's going to pour more money into this. So those are the two that we're focused on a bit more. Now, compared to the Infometrics forecast, you can see that Treasury has the unemployment rate going much higher, much quicker, but then coming back down to below 6%, you know, in about a year and a half's time. Everything's broadly pretty rosy again. In our view, though, we have the unemployment rate taking a little longer to get going, and that's particularly because we expect the wage subsidy will hold off on some people losing their jobs for a period. But we see that unemployment rate will remain much higher for much longer. We don't get below 8% until almost the end of 2022. You know, it's a long moving beast there. And all of this, I guess, is best demonstrated with this GDP chart. In this GDP chart, you can see with a lot of the Treasury scenarios, what I'd see as a V-shaped recovery. Quick down, quick back up. You can see the Infometrics GDP scenario, and this is the levels of GDP. So this is the amount of output we create each year. You can see we're looking for a much sort of lower level of activity throughout the forecast period. It's going to take a little bit longer to respond. Now, I just want to sort of talk through why we view that to be the central case, and then I'll get on to some other numbers as well. But essentially what we're seeing is that the structural change in the economy, just we can't bounce back. It's the same as if you have a string and you pull it and you pull it and you pull it. It doesn't snap back to the same degree. It's sort of lost some of that elasticity it had. This rapid redeployment and how people are going to have to adjust their lives, adjust their employment, find new skills, all of those are something that we just don't go back to normal. We have to find a new normal. And I do want to make that point because it will, in my mind, change how businesses consider where we go to from here. So again, in my mind, some of the Treasury numbers are a little bit optimistic. Right order of magnitude in terms of how bad it's going to get immediately, but in terms of what is that recovery profile, I think they're being overly optimistic. This is far, far worse than the global financial crisis. It's very much more akin to how we saw the Great Depression playing out. And the only, I guess, upside is that we're responding much more promptly than we did in the 1930s. But still some severe concerns around how the economy does develop there. One of the other things I wanted to show you, and again, I've sort of done this for the last couple of weeks, but I do want to share it with you again, and that's just noting how well our trade numbers are still doing. So the latest figures we've had through from Stats NZ shows that in total, our trade position remains in a very good way. Our dairy and our meat exports are still slightly in growth mode. In fact, dairy is around about 10% higher. So we still have that primary sector strength. And I'd expect that to, broadly speaking, continue for the next wee while. People across the world and here in New Zealand, they need to eat. So our primary sector, our food-based manufacturers, they provide us with a really strong foundation for how the economy can develop. It means that we can keep enough momentum in our regional economies to sort of go forward at this stage. So again, that primary sector is still definitely going well. And in fact, talking to people, I know that a lot of the meatworks were operating over Easter, keeping as many people on board as possible to get through some of the backlog of animals they've built up. And with dairy, we saw last week the global dairy trade auctions showed a 1.2% increase in prices for products. Of course, they'd fallen the last couple, but there's a bit of strength in there again. So again, just reiterating that primary sector, because it is going to be one of the core sectors that gets us through the worst of the COVID-19 downturn there. But I wanted to turn for the last, what have we got, broadly 7 minutes, just a bit of a conversation over where or how we need to best re-equip the economy as we come through this. And it's probably a little bit more discussion than it is data-driven. So bear with, if you will. But we've noted already that there's going to be a significant decline in construction activity, particularly from private sector-based construction. Developers aren't going to want to move forward with new subdivisions to the same degree because there's less people that are coming in, so there's not as much demand. But also people are going to be unemployed, they're going to have to sell their houses, and that's going to bring house prices down. So if you're an investor or a developer, it's just not as worth your while as previously. On the non-residential side, you've got a lack of activity coming through. No one's going to want to build additional hotel capacity. Retail and office capacity will also be a bit softer. And so there is, again, sort of a lack of general activity there from the private sector. We're already expecting some of our building activity to soften quite considerably. This has only brought that forward and exacerbated the decline. And out of interest, our webinar next week will focus much more on how we see construction going. So a bit of a prelude here, if you will, and that'll be based around our forecast we're bringing out on Friday. But if we think of those two going softer, we also know that infrastructure remains a key area of response. The government, of course, has called for and now had a huge amount of applications through Crown Infrastructure Partners to understand what that capital spend could look like. And I was on a webinar last week where I was listening to the Honourable Shane Jones, Minister for Infrastructure, with some really interesting ideas around how we go to from here. Noting as well as horizontal infrastructure, there may well be scope for some limited vertical activity as well. And the minister, in what I thought will turn out to be quite a controversial view, discussed the ability for some agencies like NZTA, Kiwi Rail and the Defence Force to actually self-consent some projects to get them going quickly. A major barrier, as everyone will know, being the Resource Management Act and how quickly we can get projects underway. But, and this is a bit of a hobby horse for me, so bear with, but what I very much think we need to change, and what Minister Jones needs to look into much quicker, is how we reposition something like the Provincial Growth Fund to really get activity underway. The Minister himself on this webinar outlined that he had struggled even to get a roundabout in his local area of Northland, which was first announced nearly 2 years ago, and there's still been no activity. If we can't even get a roundabout in Northland, how can we get the economy back going? So there is going to be a real important need for local government and local decision makers, economic development agencies, chambers of commerce, large firms, to actually be the core hub of local responses. Central government needs to provide the money, the substance behind it, but local decision making will remain critical to ensuring that we actually get people into jobs and that we have an integrated approach. Because that's something that has been a struggle for some government action so far, is it's more of a throw money out where there might be an option to get it going, and there has lacked that sort of coordinated, cohesive approach to projects. So what I will be saying and continue to say publicly is there is incredible scope there for government to support local communities through that actual local decision making. You've got to get people on the ground who know where the funding is best spent, who know the local movers and shakers to get this activity underway. But we do
Brad?
know, of course, yeah, Rob.
Yeah, any thoughts in terms of that government investment? How does the pandemic and the recession that we're all expecting, what does that mean for Kiwi Build and the housing shortage and the housing affordability issue?
Yes, there's a couple interesting elements to that. I mean, certainly on the Kiwi Build front, if anything, it's probably the best time ever that the government could look at having a second go at Kiwi Build. Now, I'll leave that to Minister Twyford and similar to consider how to move forward with that. But there is going to be capacity in the construction sector. What I do think is there's a lot more opportunity for is investing in those areas that we've previously not been able to get as much money into. We've had a bit more resistance from central government to provide straight up. If anything, I think this could well be a position to do Think Big 2.0. Maybe not at the same degree that Muldoon did it, but a similar sort of thinking to really supercharge local economies. Now, I think of being able to provide additional funding to local government to get our water assets into a much better state, increased wastewater and water supply assets, getting our pipes so that they don't crack, not having pumping sewage into the Cook Strait as our first option. It's very much the last resort because we can spend more on water infrastructure. But also we know the government's committed to an additional environmental activity. And I think this could also be an area that the government should invest a lot more in. And I think there's a lot of regional, opportunities for this, particularly in some of the energy spaces. Getting additional solar farms or other smaller activities going, I think there is merit in that. And I think, again, if it goes towards an existing government goal and there's a need to get people into work, there's some strong elements to that. But changing as well for a second and thinking about, okay, that's all good and well, but investment takes a while to get going. And I don't disagree. So we've got to think as well, once we're sort of through the next sort of year and a bit, how do we actually get people spending again? We know that when lockdown ends, everyone's going to go out, get a haircut, stock up the liquor cabinet, and then go back home and sit on their wallet a bit more. And there does remain a big question around how we stimulate people to actually spend a little bit more. How do we get them to not be so fearful about the economy? Because it will be a hard place. We're expecting that household spending will decline by around 4 percentage points over the next, by around 4% rather, over the next year. People are just going to be much more frugal. They're going to spend on the essentials, but not as much on what they otherwise would have. So reduced electronics and sort of recreation. And that's a problem when we're trying to get the domestic tourism activity back underway. How do you get people to spend domestically if they're resistive to doing anything that isn't putting food on the table or paying some of their bills? And I think, again, we've got to make some really smart decisions. Now, from a central government point of view, I think there's a lot that could be said for government coming out with some stimulus to households, giving them some cash in hand and saying, go and spend it locally. There will be very much a push for that. But all of leaving it too much to central government to just pay out cash is probably not our best idea. So I wanted to also just, and I know we'll turn over to questions in just a moment, but just wanted to highlight a few other areas I think we do need to consider as we go forward. The first one is very much a buy local campaign. And I've seen a lot of different groups who have started to pop up on Facebook and other places that have started to note what local produce, what local operators there are that can deliver, who is available, what sort of products do they offer. And I think there's a real opportunity there for a bit more of a marketplace, if you will, a local marketplace, a virtual local marketplace to get some of those businesses operating again. So that's one area I think comes immediately to mind. The other one is around how we make sure we best destination market. Now, I said to my colleagues before COVID-19 came through that I'd really love to go and do a bit more of a tour of the South Island and some other parts of New Zealand I've never been to. Never been to Gisborne, haven't really done Queenstown, any of some of those key areas that have a fantastic, really rich cultural element, but as well have some fantastic beauty around. And with my driver's license that I got last year, there's more opportunity. But I guess what I'm saying here is a lot of Kiwis have travelled more overseas than they have domestically. And so there is an element of that sort of, travel local campaign, and it will very much be focused on how do you provide great experiences for families that don't cost them a huge amount, because there will still be pressures on household budgets. But domestic tourism is very much the way we get through this. From a tourism point of view, because our expectations are that the borders will remain closed for the next year. And that's very much borne out by public comments from both the Prime Minister and also from Australian authorities. That does seem to be that the international tourism picture is out of frame for a while yet. So look, some massive issues, but I guess hoping to give a few seeds of thought, some pearls of wisdom, I suspect, around what we might want to think of when we turn to the recovery. In the very short term, the focus, of course, will be on how do we operate at levels 3 and 2, and how do we ensure that there is a comprehensive ruling over who can operate and who can't, and how that happens. Coming into lockdown, essential services were a very, very hard thing to pin down, and I think we really need some strong leadership coming through from local areas to make it abundantly clear how businesses can operate, and making sure that information is getting out to the right people. So look, with all of that, Rob, should we go through some of the questions? I see we've had a few build up so far.
Yes, we have. There's a couple that I will deal with. There's a couple around whether we're doing any work to forecast Māori employment. Now, at the webinar last week, I spoke about how Māori fared during the global financial crisis, and there was a couple of points that I drew out. And one was that Māori employment fell more than non-Māori employment in the immediate aftermath of the GFC, and there were two reasons for that. One is that Māori employment was concentrated in industries that were hit particularly hard during the GFC, like construction and manufacturing. The second point was that across all industries, Māori tended to be employed in lower skilled work compared with non-Māori. And during recessions, it tends to be those lower skilled jobs that get cut. Now we've started doing some work looking at the recent pandemic and what that's going to mean for employment over the next 12 months. We've come to one conclusion, which is that Māori are not overexposed to the industries that are going to be affected by this recession. They're not exposed to any greater degree than non-Māori, which is good news. We're going to turn our minds next to looking at the skill levels of Māori relative to non-Māori, and thinking about, well, how will that affect those employment levels going forward? And we don't have any conclusions about that next, but we're hoping to have some numbers in the next week or two, and I'm planning to write an article about that to go onto our website.
And Rob, just to touch on that point as well, I think it's important. Obviously, some of the charts that you showed last week did show that Māori during the GFC were more exposed to some industries than others. I think the point to keep in mind, and it is one that we do generally see in downturns, is that groups like Māori and young people is another one. they do seem to lose their jobs much quicker. And sometimes that's because they're in exposed industries, and sometimes it's just because those are the first groups to go, generally because of sort of lower skilled work. You can get people in higher skilled levels to do lower skilled work, but the vice versa doesn't work quite as well. So I guess a risk as well, though, Rob, that while Māori might not be overly exposed per se, they may still bear the brunt of this. And again, that comes back to what we discussed last week around the need for some really comprehensive education plans to get people into, skills retraining so that they can be redeployed as quickly as possible.
Yeah. And we've got a really interesting question about, in terms of public sector investment, do we agree with the thoughts of Rod Carr in relation to the climate change lens? Now, Rod has been advocating, in terms of like government investing in infrastructure, Rod has been advocating for investments in infrastructure that's going to help reduce our carbon emissions, investments in technology, in networks, etc. Now, I'm a bit of a greenie. I would love to see, at the very least, a carbon neutral economy in New Zealand within my lifetime, if not sooner. But I think that there's a number of dynamics that when you overlay the climate change lens to what's happening at the moment, there's a number of dynamics. One is, first of all, when economic activity falls, then carbon emissions fall. So in a sense, the pandemic is good for the planet. But and I think, as Rod has pointed out, if there is a number of instances where the economics of these kind of greener technologies don't yet add up. So when you think about, for example, developing the infrastructure for charging electric vehicles, developing the infrastructure for a hydrogen economy, there's an issue where the market on its own is not going to be willing to develop the infrastructure needed, because it takes a lot of money. You've got to put a lot of money into it before you're going to get any kind of benefit or profit out of it. So there's a case for government investment, and I think that's where Rod is coming from. I think what he's up against is possibly governments and people's unwillingness to think about those kind of higher level things like climate change when their jobs are on the line, and when their health is on the line, and in some cases their lives are on the line. I think it's easy to just go for the simple options, to go for maybe options that don't have, policy options that don't quite have the evidence base that you would want if you had the time and the consideration to think it all through. But hopefully that's not how we go. And personally, I do hope that Rod's views are taken on board by this current government. Brad?
Yeah, I think it's one of those things where it's an opportunity to invest more, and we know there's an element of investing more. And I guess in my mind, how I see it best functioning, if we are to go down that track, and I agree it's worthwhile to, it's how do we make sure we provide incentives for jobs to come out of it, and also to develop those regional economies. One of the things that I'm talking to businesses up and down the country around some of the environmental policy changes we've heard over the last few years is that there was quite a large stick element and not much of a carrot. It was bashing a lot of businesses, it was hurting a lot of businesses without providing the assistance to transition away from different elements, different operations that were seen to be more environmentally damaging. So I think what this provides is like you say, Rob, an opportunity to invest in some of those different technologies, but also to ensure that people can transition, and there's more of a carrot, there's more of an incentive to assist that growth, so that it's the lifting tide, the rising tide lifts all boats, rather than sort of punishing some with a stick. It's trying to increase that ability to continue operation, and I think we can do both if we're smart about it. So yeah, can definitely see scope for that. And there are some areas, there are some regions, I think of Taranaki as one, for example, where there is a huge amount of potential for that sort of shift.
Yeah, absolutely. Just moving to a different topic, could the fees-free and funded education in targeted areas be a good way to ease some of the redeployment and retraining needs which will be created by this recession?
Yes and no. I mean, one of the issues I've always had with fees-free, and this is a personal view, so take it as it is that it doesn't allow for any sort of targeting. You could have a whole lot of people, for example, going into a sector that just doesn't have any growth, and there's no ability to manoeuvre those people around. As well as that, of course, with fees-free at the moment, anyone who's had a job and has now lost a job that might have previously gone into higher education isn't eligible for fees free. So I think probably needs to be something slightly different than fees free as it currently is. That one provides a little bit more of that ability to retrain where people have previously had qualifications. And this comes into the point I've probably harped on about it every webinar, so apologies for those of you who are getting sick of it. But that element of the importance of something like a regional skills leadership group to actually identify what is coming next, what sort of skills do we need, how do we ensure we deliver those best, and how do we integrate that through so that we don't just have someone that goes into education, if you will, does their learning and then goes out into the job market and it's very separate. How do we get them doing the same thing, that they go through the education pathway and straight into a job so there's no big break?
Yeah, absolutely. Do you think that lowering the GST could be a way of stimulating spending post-COVID?
Possibly. I think, I mean, one of the issues and it was an issue that was bandied about prior to the lockdown coming in. I think one of the issues you have with something like a GST change is it's a pain for businesses. They have to change all their systems and what have you. So my thinking around tax changes is, broadly speaking, for existing taxes that we don't have any great issues with, and in my mind GST is one of the sort of cleanest and it's quite well in operation. I'll be much more partial to money that's already collected being reapplied to households, given back, rather than sort of a change in prices. I'd rather there was sort of more of a subsidy effect that came in. That's sort of an economics point of view, but it does also, to a degree, lower administration costs. It doesn't mean that every business has to change their GST settings and what have you, particularly if it's one of those things where we change it for a period and then want to bring it back up so that we can start rebuilding the economic safety net that we've created as a country with low debt levels. We have to repay that at some point. So I'll be much more partial to actual sort of cash stimulus to households when we get to the recovery phase. And what that also allows is you to target different groups a bit more. And you know, as a headline idea, you could give every household in the country $500 to stimulate that spending. But you could give anyone who's in a household who earns below $40,000 a year an additional $200 on top of that, so a total of $700, because we know that they spend it more, and we know that they probably need it a bit more. So trying to get that stimulation going through a little bit more targeting, I think, is more effective than just an across the boards cut. And it's the same sort of idea as to why I'm not as partial to a universal basic income. Rob, you and I probably don't need a UBI. And there's a lot more people out there who do. And if we give a UBI to everyone, it diminishes, it lowers the amount we give per person. I'd rather we give more to those who need it to get them back on their feet, to get them back into the economy.
Yeah, we've talked about the government's in a good position in terms of being able to stimulate the economy, but at the end of this, there's going to be a lot of debt. There's going to be a lot of government debt, and so it's as important as it ever was to make sure that every dollar that's spent is an effective dollar.
Yeah, and it's one of those things as well. I mean, everyone always sees taxes as sort of taking money, but what it has provided in this sense, this is essentially our pandemic insurance that the government's taken out on our behalf. And so we have to make sure that once we have used it up, that we rebuild it, because this is not the last event we'll ever have. You know, the earth continues to move beneath our feet. We will have further earthquakes and further disasters. We may well have another pandemic at some point in our lifetimes. So we do need to rebuild that buffer.
Yeah, some questions about our modelling. One was, were any assumptions made around our capacity to let foreign workers into the country to cover the skill shortages? We've assumed that the borders are basically going to remain, New Zealand's borders are going to remain closed for the next 12 months. So that means there won't be, certainly won't be any temporary work visa holders allowed to enter. There has existing work visa holders who are here have had, some of them have had their visas extended. So if they want to stay here, they can. And I think probably at the end of those 12 months, we've assumed that actually net migration will turn negative, as a lot of people will be wanting to leave to go back to their homes, and that will outnumber the people who are coming. But basically, our broad assumption is that the borders are going to remain closed for the next 12 months. So there won't be anyone coming in to fill those skill shortages, if indeed there are any skill shortages over the next 12 months.
I think the point as well, Rob, that we've I think we've already made this with our modelling, is it sort of our current expectations of how the economy moves, and as those actual conditions evolve, as government makes more calls, and we see those calls, we also adjust our numbers a bit. But we did want to sort of provide a little bit of a headline snapshot of where our thinking is, like Rob said with some of those numbers earlier, but it is very much conditional on how the government decides to restart the economy. But certainly our expectation is that those borders don't get going anytime soon, because if we do get rid of COVID-19, and we are in the best position to do so, we don't want to sort of let it run rampant back into the country anytime soon.
Yeah. And just going back to the regional skills leadership groups, who do we think are the critical people in this to make it effective? I might have a first go at this and then hand over to you, Brad. I think people with networks, good networks in the region, I think is more important than perhaps the position that like the work position that they hold. One of the things that always vexes me about these kinds of groups, and it's not the first time we've tried to do this kind of thing, it's that you need people who have a kind of a seagull's view, not quite a godlike view, but a seagull's view of their local economy. And preferably one that is based on their own experiences and talking to a lot of people. We don't want people who just know a very small pocket of their local economy. We want people who can look across the broad scope of their economy and have a good sense of what those skill needs are. Now, that's not an easy thing to get. I think it's the kind of thing you get from living for many years in an economy, having a number of roles that allow you to develop a really deep and broad network across your local economy, and obviously a continuing interest in the workforce, in skill needs. So I think it's more about people and personalities and their capabilities rather than the positions that they hold. But more broadly speaking, I would say the most important thing is a good sense of somebody who can represent the interests of the workforce, of employers in particular, and have that voice for all employers in terms of what employers need, particularly from vocational education, because at the end of the day, vocational education is supposed to be geared towards the needs of employers. Brad?
Yeah, no, I agree. I mean, the one thing I immediately think of is you got to have someone with a bit of mana. They've got to have that mana behind them to know what's happening, to be able to respond promptly. But like you say, to have those networks, to have those connections. But you're also right, Rob. It actually needs to be industry, and I think we also want to be careful that there's not too many people that are focused on managing activities. There's positions for that, and they're in operations. What you're looking for here is some real strategic thinkers. They know where things are going to go because they're on the coalface. You want those people who are out there spending some of their day understanding where the economy's going and what skills are going to be needed, but that's because they're talking to other businesses. They're doing business themselves to understand what's happening. So some of those core local business leaders, and I think it's one of those things where actually the community could come up with those lists quite easily, because they're people that everyone knows and everyone trusts that when they ask them to do something, it gets done.
Yeah, absolutely. Just some questions about our forecasting, which I just want to clarify for us. There have been questions around our forecasts of industry employment. We're going to be we've already got some very basic numbers. We're going to be developing them a little bit further over the next week or so. And we're also adding a Mari lens to it. So in terms of timeframes, a week, possibly 2 weeks at the most if we come across any problems. But yeah, and we'll be getting those numbers into those regional reports that we mentioned earlier. Might just talk about, there's been a few questions about government spending and debt. Any thoughts about the amount of debt that the country will incur over this period? There's figures on government borrowing, but also private sector borrowing.
Yeah, so taking the government stuff first, what I understand from sort of hearing reports, particularly from the ratings agencies, is that New Zealand could well, in normal times, borrow sort of 30%, debt to GDP ratio, net debt. So we exclude the NZ Super there because it's a cash fund we can't access. So we're currently sitting at around about 19-20% debt to GDP. We could well go to 30% in normal times. Now, of course, a once in a century pandemic is not normal times. And my thinking would be, and certainly some of the estimates I've seen, we could go up to something like 50% debt to GDP. Before we start to, and past that point, we really start to have a risk of how do we recover that debt, and I suspect we would see a ratings downgrade. It would be more expensive to borrow. So I suspect 50% debt to GDP is probably an area we could get to. Now that still means we've got tens of billions of dollars to go before we run out of money, if you will, before we can't borrow any more. But it is worth noting that we can't just sort of burn a whole lot of cash willy-nilly. We do have to make sure there is some structure around it, and that we do not only get ourselves through the worst of this economic downturn, but also have enough to restart on the other side. So there is an important element there. And of course, we do have the ability, and we have seen the Reserve Bank already intervening using quantitative easing to try and make sure that interest rates remain low, so that when we are borrowing, that those repayment costs remain at the lowest possible level. On the private sector debt side, look, I think there's some real concerns around how that comes through from 2 points. One, we know that our household sector is already relatively indebted. That they've already racked up a fair bit of it, particularly in property. But secondly, we know that through the next wee while, businesses just aren't going to invest. They're not going to take out additional loans apart from to tide them over. They're not going to be sort of borrowing for new capital and new purchases. They're going to be sitting on their hands a bit more because of that sort of risk factor. So this is very much the point where government has to step in because the private sector is unwilling to. And that's generally how we see the government operate. It does stuff that everyone else is sort of too small or too isolated to do in of itself. It's that collective action that government provides.
How can we best use our economic development agencies in terms of the recovery? I think we can use them a lot. I think they have really deep networks into their regions, and those networks can be used to provide feedback back to regional government and central government in terms of how their investment policies are working. That feedback mechanism can also feed into the regional skills leadership groups in terms of giving employers a voice in what their skill needs are. I would also hope that EDAs have a good sense of what the comparative advantages are for their regions, in terms of what kind of jobs, what kind of job opportunities can you create that are going to be best placed for that region rather than other regions, and kind of leading on from that, being a voice and an advocacy for their region. Either in terms of attracting government funding, or increasingly as we start to recover, looking abroad for export opportunities or opportunities to bring in workers from overseas to fill those key jobs that the regions are going to need.
Yeah, I think there's also a really key coordination role in local economies that, businesses are having a real tough time of it at the moment. They're struggling to understand how and where they move to next. And I think EDAs are very well positioned to ensure that they can link up struggling businesses with the right advice, to get them the right tools, to make sure that when they are making decisions, they have that sort of information at their fingertips, navigating how and what some of the government regulations regulations mean at level 3 and level 2, having that sort of information, being the one-stop shop that if you have a business question, the EDA is sort of positioned to discuss it, can coordinate and connect you with someone else who can provide more detailed insights, and who, like Rob said, sort of has a direct connection to some of the key decision makers to make sure that when things aren't going right or issues emerge, that they're raised promptly and responded to promptly.
Yeah. And the new unemployed will be different, as they will be very motivated. How do you see this impacting on the economy? It's a really interesting one. I think there's going to be a number of people who become unemployed who are going to be highly employable. And it's going to be really important to get those people back into work as soon as possible. My main concern with the unemployed, especially those people that were unemployed before the pandemic and have perhaps been unemployed for a wee while, they're going to be competing for jobs now with an increasing number of people, and people who have been in employment more recently than they have. And that's going to be tough for them. And yeah, what worries me is 12 months from now that we have a group of people who've been unemployed for at least 12 months or even more, and are starting to lose those kind of ready for work skills. And that's just, it's really important from a public policy point of view, because you're continuing to pay benefits for those people, but more importantly from the point of view of those individuals and their families, how that long-term unemployment can have such a detrimental effect on people's welfare.
Yeah, I think as well, Rob, the thing is they might well be highly motivated at the moment, but because we don't see their unemployment rate, dipping considerably for a while, I do think some of those people will get to a point where they get frustrated with not being able to get into employment, that essentially, even though they might be ready to go, there's sort of nowhere for them to go, that they do eventually slip out of the labour market. And we were already sort of seeing that to a degree prior to COVID. There was a group of people, one of the reasons we were seeing the unemployment rate go a little bit lower is because there were some people that were going, look, I'm not going to look for a job because I haven't found one. Obviously, my skills don't match what people want. So I'm either going to go and do some education, or I'm just going to stop looking for a bit. And I guess there is a fear there that sort of element does continue or exacerbates. So there may well be a group of people who aren't as engaged in the labour market, not immediately, but sort of over, in the next 12 months or so. And so it's important to make sure that we also understand what are the skills, what are the motivators that will get these people back into work, so we can communicate that, so we know what that pathway looks like, so that we can sort of get people back into jobs as quickly as possible. It's not going to be particularly fast, but it does mean that there will be, I guess, that recognition that jobs will come.
Yeah, an interesting question, and this is kind of a follow-up to the question about how there being fewer work migrants coming into the country, and what effect that will have on all these investments in infrastructure, and will there be a big enough pool of people to draw on for these projects? And I'll start, and I'm sure you've got something to say about this, Brad. On the face of it, you can say there's going to be a number of people made unemployed who will be ready to take on these kinds of construction jobs. But the two things you have to consider are whether they have the right skills, and secondly, whether they live in the right area of the country where the work is. And that ties into another question about whether we foresee rural migration back to the regions. And I think I've just made a note. I think I'm going to maybe have a look at how inter-regional migration fared during the global financial crisis, because and think about, well, whether that's relevant for what's happening today, because the labour market needs to be able to adjust. And as Brad said, there's going to be a number of people who are going to be put out of work. They're going to have work experience in certain kinds of jobs, and they're going to have certain kinds of skills. And there needs to be, as those jobs start to be created again, there needs to be a reallocation of people into those new jobs. And that's a skill-based thing, but it's also a location thing. And so if there's a bunch of infrastructure projects going on in Auckland, but there's a bunch of people who have been made unemployed in Queenstown in the tourism industry, you're not necessarily going to get that reallocation happening very easily. Now, in terms of whether people are going to move back out to the regions during this recession, there's a number of dynamics I can imagine happening. One is that the housing market might be a barrier to that. If people can't, say, if people in Auckland can't find a buyer for their house, and they might find it a lot harder to move back to their family, say, in the Bay of Plenty. On the other hand, people who have been put out of work might be looking for places where rents are relatively lower and housing affordability, property prices are relatively lower. So if they can make the move, maybe they might be more inclined to make the move. Brad, have you got any thoughts on that?
Yeah, so on the first bit around sort of how do we cope with some of these large increases in infrastructure spend and that, it's important to remember that we have had construction, which is, as a workforce, which has grown incredibly over the last 5 years. And with an incredible downturn as well expected in both residential and non-residential building, there's going to be a lot of people in the broader construction sector who are looking a little bit more vulnerable. And so this infrastructure stuff gets more of them employed first, and then we turn to those who didn't already have jobs. So from a capacity point of view, I think there's actually quite a bit. Of course, noting Rob's very salient point around how do you actually make sure you have your workforce in the right spaces. Turning a little bit to the regional migration stuff, look, I think there is certainly scope for people to move back into some of the more regional areas across the country. And I see that because there is, like Rob said, a lower price point, but there's also the ability, or I think the increased potential over the next sort of, say, decade, and this might be a longer term trend, of people who we now know can work from home, and that focus on sort of remote working does provide more scope for people to live in more regional parts of the country, but to still work in what might have traditionally been an Auckland, Wellington, Christchurch sort of office job. You know, we're probably a good example of that, Robert, here at Infometrics. You know, we can and already do, and it already did work at home a lot. So some of those changing elements, I think, very much could support it. I think, again, if you're trying to attract people into your local area post-COVID, there's that element of what is that price point? You know, how do I make myself attractive from a dollar point of view? But also, what is the lifestyle? What are the connections I can have for me and my family? And can I still access the services I want to? But also, and one we've started to see coming through a lot across the country is, how do I make sure I've got good internet connectivity? And I think the government may well want to sort of think about how it extends some of the UFB rollout, or at least enables that greater connectivity across the country.
This is an interesting question. Is large-scale investment in research and development a vehicle for delivering government funds to business, and which industries are obvious opportunities for this? I think, broadly speaking, and traditionally, there's always been a bit of a disconnect between research and development and business operation. There are obviously different kinds of research and development. I'm thinking mainly of the kind of research that tends to go on in the kind of the academic space, which tends to be more primary research. There's always been a difficulty in commercializing that kind of research. Now, businesses themselves do a lot of R&D, and there are obviously policies in place to try and incentivize that. As a large scale vehicle for investing in business, I would say it would have to increase by several factors. At the moment, government investment in R&D is relatively small, and business investment in R&D is relatively small. It's usually a few percent as a percentage of total company spending. So a possibility, but probably not a vehicle for large-scale investment. And as you're still trying to get over the kind of the traditional problem of trying to connect research to innovation and business operations. Anything to say on that, Brad?
Yeah, look, I mean, New Zealand and I'm sure many other countries, we've struggled to get R&D done properly for businesses for many years. And so is there an opportunity? Yes. Is it through how we normally do it? Absolutely not. Because if we can't crack it in normal times, we certainly won't get it done when businesses are considering things in a lot more difficult circumstances. I think you're right though, Rob, that defining exactly what R&D is important. You know, essentially what we want businesses to do is to have a little bit more freedom and a little bit more comfort to take risk, to decide on trying to pilot some new operations, some new way of doing things, and how to do that while sort of making sure it fits criteria is quite difficult. So I'm not saying I've got an answer here. I'm saying that there's potential, but it needs to have a very rapid shift in how we normally think about it. I mean, one of the things that, of course, a downturn does provide is it does allow some firms to think, well, look, I've got a bit more downtime, I've got a little bit more softer activity. How do I best redeploy my staff or my resources to extract value when we hit that recovery, when we hit the upturn? How do I best position myself for that? So considering how to incentivize that is an area, I think, of opportunity there. I'm just noting as well, Rob, we're at sort of 12:04. We got one more quick fire question, and then I think we'll wrap it up before we take
Yeah.
everyone's day.
One of your favourites about rates, whether there should be rates increases versus freezes.
Right down the middle, I think, is my broad answer. I don't think I'm a fan of rates freezes as a sort of just the immediate knee-jerk reaction, and that's because, one, it means that you don't have as much ability to keep your local economy going. We know that local government is a huge funder of local activities, and it's important to keep that stuff going. But it also means that you have to have a rates rise at some point. You either pass that debt on to future generations, for which I don't, that essentially just kicks the can on down the road, or you have to have a large rates rise in the next few years to compensate. So you might have a 0% followed by 20%. Now, is that palatable when businesses and households are trying to get back on their feet? I'd rather we had a smooth path of rates increases, so that we can plan around them and so that household budgets can reflect how those changes are. Now, I'm not saying we have a large rates rise this year. It is important we try to trim that back as much as possible, but it's important we don't sort of, what's the phrase? Bite your nose to spite your face, or something. That's probably completely wrong. That phrase though, Rob, you'll have it. You'll have what it actually is. But that sort of thing, this is a long-term game, and we don't want to just kick the can down the road and have a knee-jerk reaction.
Yeah, I think we'll call it a day.
Awesome.
Thanks, everyone. Thanks for your attention. Thanks for your questions. As Brad indicated, this time next week, we'll be looking a little bit more about sectors. As we've indicated, we're working on our short-term forecasts, and we're rolling out our regional reports over the next few weeks. Most of you have probably heard from us about that. If you haven't and you're interested, get in touch. And in the next couple of weeks, we've got our newsletter coming out, which will be bringing together a bunch of articles that basically cover the whole breadth of our work that we're doing around COVID-19, and might give you some insights into some areas of work that you might not have been aware that we normally do. But until then, we'll hopefully see you all next week.
Fantastic. Yeah, thanks everyone. We've had a great time. I hope you've enjoyed it. I hope it's been useful. If you've got any feedback, feel free to email us and we'll take it on board, and we'll have a recording of this up on our website sometime later today, maybe late tonight. Thanks. Keep safe and have a good one. Cheers.
Yeah.